I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, January 31. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. May you live in interesting times. It's an ancient Chinese curse. You've probably heard it invoked before. January certainly has been interesting for investors and financial markets. But by last week's end, the curse had lost a lot of its sting, with stocks slightly ahead. It was a nerve-wracking week, a stress test, if you will, but the markets, they didn't crash after all. To be sure, we've endured a dismal start to 2022 so far. January has been chilly for investors, but last Friday, markets rebounded and they posted their best day of the month. The bull still shows signs of life. The Federal Open Market Committee meeting on Tuesday and Wednesday resulted in the Fed preparing markets for a March hike in the Fed's policy rate, the first such hike since 2018, as well as the conclusion of asset tapering. But after a turbulent week that saw several consecutive days of losses, the market capped last week with a powerful rally. By the end of last week, the major U.S. indices had managed to hold their own and avoid being in the red. The battered technology sector was in the vanguard, propelled by bellwether Apple. Apple posted strong quarterly operating results Thursday. The reported demise of the tech sector has proved premature. See the following table. One factor rekindling optimism is the fact that Treasury yields stayed below 1.8%, as you can see on the table. Crude oil prices also finished higher for the week, a sign that traders expect economic growth to drive greater energy demand. Take a look at this chart. Major oil producers are reporting solid operating results, especially big oil stalwarts such as Chevron. It's been a rough winter for investors so far, but keep your sense of perspective. Consider this. The S&P 500 is up nearly 95% since its March 2020 lows. What's more, we never got a downturn of more than 5% in 2021. But historically, 1 to 3 corrections in the range of 5% to 15% are normal in any given year. In coming weeks, the biggest risks will be among the more speculative investments, such as cryptocurrencies, non-fungible tokens, and excessively valued stocks. A lot of fawning media coverage has been devoted to cryptocurrencies, in large part because analysts on TV need a colorful narrative. However, this asset class has plunged in value lately. The greatest opportunities will be among sectors that benefit from cyclical economic growth and rising rates, e.g. energy and financials. Wall Street has now priced in about 5 rate hikes for 2022. The Fed will probably get aggressive in the early stages of its tightening cycle. One factor that both helps and hurts American households is rising wage growth. See this chart. A tighter labor market that results in fatter pay envelopes, it does give consumers more financial wherewithal, but it's a major component in hotter inflation. It's my view that inflation will probably ease from currently elevated rates, but not until the second half of 2022. A positive factor is healthy U.S. gross domestic product growth, which is not too hot, not too cold, aka the Goldilocks scenario. Take a look. Because we're not near the conclusion of the economic expansion, I continue to believe that market sell-offs can be leveraged as buying opportunities. Many story stocks with inherent appeal were trading at nosebleed levels. Investors will now get rare opportunities to buy them on the dips. Keep in mind, equities historically have performed well during the beginning of Fed tightening, especially during the 6 to 12 months after the first rate hike. Over the past 5 cycles of Fed tightening, the average stock market return in the year after rate hikes began was 5%. The upshot? Optimism is warranted. Stay cautious, but stick to your investment strategy. As desirable stocks land on the bargain shelf, now's your chance to scoop them up for portfolio diversification. Are you looking for guidance in these turbulent times? In a new symposium, my colleague Dr. Joe Duarte, Chief Investment Strategist of Profit Catalyst Alert, revealed his number 1 Profit Catalyst trade for 2022. This trade is poised to make money regardless of the path of the pandemic or Fed policy. To learn more about his trade, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Okay, that does it for now. Thanks for watching. I'll see you again next week. In the meantime, here's to your health and your wealth.